Okay, next session 4 is titled Collective Thoughts from the Buy Side, What's Driving Their Latest Investment Decisions. If I could welcome our next panel, which is going to be moderated by Bernard Ronke, Director of Investor Relations from CSL. Welcome, Bernard. This session is going to take the form of a 10-minute presentation in the first instance by David Metcalfe, who's Head of Sales for Australia for Visible Alpha. Visible Alpha is well known to many of you, and I know a number of members subscribe to Visible Alpha. David's going to speak for about 10 minutes about consensus estimates and what some of the trends that Visible Alpha are seeing. And then rest of Bernard's panel, which includes Anna Milne, who's an equity analyst at Wilson Asset Management. Welcome, Anna. Raz Buhan, who's a Principal and Portfolio Manager at Wavestone Capital. Welcome back to you, Raz. And Mark Nathan, who's Head of Fundamental Research and a Portfolio Manager at Regal Funds Management. Welcome to you all. Thank you very much for joining us. So I'll hand over to David. Thanks, David.
Thank you all, and welcome to day 2 for the event for those of you who are just getting in from early meetings. I felt it was perhaps a little bit more prudent, rather than me trying to weasel my way onto a panel with the buy-side fundies, to instead speak first and then and focus more on observations that we've seen on the market that we find relevant both to the buy side and to the investment relations community. So first things first, it's best for me not to assume that people do know who Visible Alpha is, and I would probably get in trouble with my marketing if I didn't at least go over it for a couple of slides. Who we are and why we're a little bit different is Visible Alpha is actually a partnership from a sell-side consortium to surface the most detailed and granular street fundamentals, both actuals and consensus, to ultimately the buy side, and then also people that work with the buy side for street consensus. Right? What we do, you can see some of our strategic investors up there. So in particular for Oz, you'll see a lot of the major players on the sell side here. So UBS, Macquarie, and Goldman's and various others. But we actually have a panel of 175 brokers contributing. These guys are just the ones with an ownership stake, and probably another 20 onboarding currently. So we have really good depth and breadth for the market. What we do that's fundamentally different to everybody else is we get our data from the underlying sell-side models, not a Diet Coke version of the model, the full working model that we are sent from each analyst for every firm that we cover. From there, through a combination of brute force, man hours, natural language processing, algorithms, and intelligent computing, we are then able to create company-specific models for every firm that we cover in our database, so that if you're looking at consensus or detail on any firm, it's as the street models it. It's not just standardized metrics. We're not scraping this from research reports. It's not just a few data items, and that's what really sets us apart. We also have a standardized layer between that, so you compare apples to apples, but that's really what we do at Bread and Butter. And so there's a screenshot of how detailed it can get. You can see, we go right down to total production, cash cost per commodity, mine site. If you're looking at a big pharma company, you'll see oncology drugs, HIV drugs. We go right down to the absolute depth. And that's why the investment relation community has been great with working with us, because we can help them get insight on what the street's modelling for them too. So that's a sales plug over. What I wanted to do is talk a little bit about a few things that we've seen evolve in Australia over the last a few years. I like to think of everything as pre-COVID, COVID, post-COVID, but obviously the market and the relationship with street estimates has been existing on for much longer than that. So I want to say 2 observations that we've noticed, and then pose 2 questions to the panels. So the first observation is that the information investors have made has really evolved from just being street estimates. I'll touch on that on just a few basic items. The second observation is that proliferation of data and really everybody's expectation to get that instantaneously has meant that investors need much more systems and much easier to use systems. The 2 questions I'm going to pose are, is the rising tide that's lifting all boats finally gone out, and is it now a stock picker's market? And we'll talk a little bit more about what a stock picker's market means. And then also how significant is the role of consensus and guidance versus surprise in driving stock returns. So our first observation on more data. I'm perhaps showing both my greying hair and the fact that I've been a data nerd for a very, very long time, in that in 2010, which I don't think was that long ago, there were 23 data points in consensus for the majority of the Australian market if you were to go to any of the major providers. There were only 2 specific industry metrics, FFO and NAV for REITs, and most items that weren't just EPS or sales were annual only basis. So that probably made investor relations a lot easier. Many buy-side firms in Australia actually had complex in-house built systems, SQL databases or what have you, to actually collate information straight from the street, and it was infrequent updates and they had to often prompt them for it. And that source is from the old IBIS estimates, which was the gold standard probably up till about 2009. Now we have hundreds of data items per company unique to each company. Industry-specific metrics are the most important drivers. People don't look at Netflix's earnings, they look at their monthly active users, right? And consensus exists on those segments across, and people care really, really much about these fundamental drivers more and more than they actually care about, say, revenue. And guidance, unfortunately for you guys, is expected on everything. So the second observation is just more systems. There's a bit of text on this slide. I'll save that for when we send it out later. But essentially, firms that used to have access to all of this data used to just be the big ones. Now, almost every hedge fund or investment manager has access to the same sort of high-quality content that previously only existed if you were like, the artist formerly known as BTO Investment Management, Colonial, now First Frontier, Pendle, Perpetual, etc. Right? So now the smaller funds and the boutiques really, really have access to this. The demand from investors is real. So market data spend, and we define market data as specifically data and systems that relate to financial investments. It's up to almost 40 billion last year. Globally. And the fastest growing segment is valuation and reference data, which is different because the previous year it was all about real-time pricing, right? So that's the previous 10 years, and now actually cares about specific information per firms. And new forms of data delivery and tech, I don't need to tell everybody here. I still remember when I thought I was the coolest guy in town because I'd finally gotten a BlackBerry, right? So, we all used to have a Nokia 3310 or 15. We all had a BlackBerry, now iPhones. So it's pretty obvious what's happened in tech. The more people tell me, oh, I don't need it, I'll just look at the company filings, the more I think, yeah, really? So that's our second observation. So our conclusion is that there's so much more on the plate. So these are just some stats for our Aussie coverage as well as our global coverage. So our biggest data item is actually an Aussie company. We have over 1.7 million data points for BHP. They do a lot of things. And we now have an average per company of 148 consensus line items. And that means 4 more brokers are actually modelling something on a firm. And we have, as you can see, the line items that we're having here for the Aussie market are pretty impressive. We cover 6,500 companies globally, which is a lot. Most people in Oz only benchmark to the, if they're a global investor, to the MSCI All Country World, that's 2,800 stocks. So you can see that's a huge amount of data, and no average punter is really easily able to digest that. So the question that I have is, are we in a stock picker's market? So we've done some basic analysis. I'm going to let the folks from who are actual fundies speak to it a lot more because they're much better at doing a correlation matrix than me. But we've noticed that correlation in stock returns globally is declining, right? So I've got a couple of quotes up there from Warren Buffett. Everybody knows him. And for those that were following the news and a few wacky stocks apparently only went up after in the first explosion phase of COVID. So that was every tech company. For just tech, it just rocketed up. So now we're finally seeing earnings, quality of earnings, and also how close they are to guidance on those earnings is starting to separate winners from losers again. And we also saw them at the last Aussie reporting season when we had a clear line between the people who actually proved that they had ongoing solid businesses versus those that were just doing one-offs and some concerns as well. And that sort of leads into a second part to the question of where do we go from record earnings? We've got a lot of firms here in Australia who basically had the time of their lives, and it's going to be a little bit different over the next 12 to 18 months. The second question is, I'm picking on Bloomberg and the AFR for releasing a news article just over a week ago which said that companies' earnings guidance is wrong 70% of the time. I'm sure there's some IRFS folks in this room who'd perhaps dispute that. This is based on an academic paper looking at a correlation between fundamental results and also street estimates over a considerably long period, but it is US based, so do take that with a grain of salt. It was interesting because most corporate IR managers thought they were right 70% of the time, so it was almost a complete flip between what was reality and what they thought. And most managers, though, did admit through this paper and this survey that they almost always gave conservative guidance because they were scared of getting in trouble for understating it. So how do we close that information gap? How do we interact better with the street? Our job as a vendor is just really to help make that easier, as it be a vessel to surface it. But it is an ongoing concern because companies are being punished for almost being too truthful, it seems. I note we had Angela earlier spoke a little bit about shareholder activism, but interesting also the paper noted that the benefits of guidance and the adverse effects of guidance didn't really revolve around shareholder activism. The main benefit was always managing analyst expectations. That was the most important thing about consensus for investor relations teams specifically. And the biggest adverse effect that they found was reporting results that fell short from guidance, which that one seems pretty obvious. So my question to the panel is, how important is guidance for you in making your stock picking decisions relative to consensus? So I'm going to wrap up a little bit early so that there's more time for questions. I will say, in terms of questions, our CEO is just sitting over there, so I'm throwing him under the bus. If anybody does have any questions about Visible Alpha, he's around for the rest of today, and we're very, very happy to talk about on what we're doing in the market, what we're doing with the buy side, and what insights our data is providing. So there we go, tick marketing. Thanks, everybody.